This is Chapter 9, and in this chapter we're going to be looking at budgeting. Budget is a detailed financial plan for a future time period. It helps management determine how to allocate scarce resources. It's a way to communicate goals and plans to managers and staff, and as a way to estimate future costs and revenue. So when you're developing a budget, you really need to start from the strategic plan. So the strategic plan sets out the long-term goals for the organization, and that may extend, 5-10 years into the future. And then a rolling budget, that is updated every year for the next 12 months because, obviously estimates change, so you need to keep updating your budget. In terms of budgeting, sometimes there's a budget committee, other times, each department would prepare its own budget, but generally many people in the organization are involved in preparing a budget for their particular section, and then the accounting department has the task of putting it all together. So some of the benefits in developing a budget, certainly the lower level managers need to be involved because they have the more detailed knowledge of how much things are costing in terms of materials and labor. And if you're going to base bonuses on performance, if they have involvement in preparing the budget, then they're going to be probably more willing to accept the budget and be motivated to make sure it's adhered to. The more people you have involved, of course, in preparing the budget, it's going to make it more complicated. Plus, some managers may build some slack into the budget, so they don't want to probably be as realistic with the numbers as they could be in case they're off a bit. So if they're building slack into the budget, saying, well, materials could be $10 a unit when really they're going to be $8, but they just they don't want to be boxed in just in case something goes wrong. So there's two main methods for developing the budgets. You can start with last year's budgeted or actual results and then adjust the accounts accordingly depending on your goals or the economic forecast. And the other option is zero-based budgeting, where you start completely from scratch. And this is very time consuming. It's not something that would be recommended for an ongoing business, but if you're starting a new company or you're in an emerging industry, or you're introducing a new product, you may start from scratch, but that's usually, it's very costly and time consuming to do it, but it can be warranted depending on the situation. So some of the benefits of budgeting is, of course, it forces people to plan. Budgets really promote communication and coordination between the department, and it provides a benchmark that motivates the employees and helps the managers evaluate performance. So when we talk about a budget, it's not just one document, it's several sub-documents that make up the full budget. So you have a sales budget, then you have your production budget. How much is it going to cost you to, make that particular product? But then going into the production budget is your direct materials budget, your direct labor, and your overhead. Then you have your operating expenses, and then your budgeted income statement. So a budget is a bit more complicated than it looks. So when you're doing a sales budget, of course, you're going to start off with your predicted number of units that you're going to sell, your selling price per unit to give you your total sales revenue. So for Tasty Tortilla sales budget, here they're looking at selling 30,000 cases of tortillas. In January, 20,000, February, 25,000 in March. And the selling price per unit, $20. So then, in this particular situation, they're offering their customers credit arrangements. So they're only collecting cash on 20% of their sales, and the rest is on credit. So the credit terms can vary. It could be 30 days, it could be 20, it's just all up to the company to decide what they're willing to extend in the way of credit. So it's important to look at the cash situation, because you'll see this later in the chapter, because if you are offering a lot of credit sales, then you're probably going to need to borrow money, short-term borrowing from the bank, to cover your some of your operating costs, and we'll see that a bit later. So we start off with the production budget. So we just saw that we're going to sell 30,000 units of the in January, 20,000 February, 25 in March. You don't typically start off the year with zero inventory. You always start off with some inventory left over from December when you go into January. And the other thing you have to consider is you don't want to end up at the end of the month with no inventory left. You have to build a bit of a buffer, because remember, these sales units are projections. You may sell a bit more, you may sell a bit less, so you don't want to have a shortage. So the number you're going to have to produce, so you're going to have to produce enough to cover you've got 30,000 in sales, you're going to sell 30,000 units, plus, because you don't want to run out, you want to have 10% left, that's equal to 10% of the following month's projected sales. So in this case, they're projecting they're going to sell 20,000 units in February. So ideally, they would like to end the month with the 2,000 left in inventory in January. So the number of sales, 30,000 units, plus you want to have 2,000 units left over at the end of the month. So you need 32,000 units. But you didn't start the beginning of the month with zero. You brought some over from December. So you had beginning inventory of 3,000. So that means, although you're only selling 30,000 units, you only have to produce 20,000 because of the fact that you started at the beginning of the period with some inventory in stock. And so this just continues on. Each month you do it the same way. The number of units that you are going to sell, factor in the number of units you started with, and then how many units you'd like to have left at the end of the month, and the difference is what you have to produce. And you take the same approach with the materials. So now, to produce the 29,000 units, you're going to need 5 kilograms of direct material. And then you're also going to want to leave, at the end of the month, 10% of the following month's sales. So 10% of the 102.5 gives you 10,250. So what you need in materials is enough for the current sales plus the desired ending inventory. But then you started the beginning of the year with 14,500 units in inventory. So what you really need to produce here then is 140,750. And the cost per unit, $1.50 per unit, which would give you your 211,125. Again, repeat the same pattern. It's always how many units that you need to produce, the number of kilograms of material needed, so that will tell you how much material you need, but then you have to factor in, you want to have 10% of the following month's production on hand at the end of this year. That will give you the 155, but you don't really need to buy that much because you already had some in beginning inventory. This 10%, this is totally up to a company. A company might decide it only wants 5%, some may want 20%. That's an arbitrary number, but the idea with having a certain amount of ending inventory is that you don't run out. So you're projecting, say you'll sell 29,000 units, well, maybe you'll sell 30,000, for example, so you don't want to lose customers by not having enough product on hand to meet demand. So that's your direct materials. The next factor in the budget is direct labor. This is more straightforward. So it's the number of units times the number of hours per unit times the hourly rate. So that's probably the easiest piece of the budget to do. Now, manufacturing overhead, this one is a little bit longer. It's not necessarily more difficult. It just has more components. So with the overhead, as you know, you have some of the costs are variable and some are fixed. So when we're looking at our cost, so again, we're back, we're producing our 29,000 units. We've just calculated We know that here on the variable cost side, we have indirect materials, indirect labor, and utilities. These are all variable manufacturing costs. So those get factored in next. And then the next group is their fixed manufacturing overhead, which has nothing to do with the number of units, depreciation, insurance, indirect labor, utilities, etc. So those costs are fixed. So here you can see your total overhead for each month. Now we're looking at operating expenses. So the previous one, it was manufacturing, so all of your variable costs to produce the product. Then we did the overhead in this one. So now it's the operating expenses. Some of the operating expenses are variable while others are fixed. So for variable operating expenses, and these are fairly typical in most organizations, you have, say, commissions, $1.50, your shipping expenses, bad debt expense. You don't always, unfortunately, collect all of your credit sales, so you make a provision for bad debts. So here you have all of your variable operating expenses. Then the next group of expenses you want to do, now these are more straightforward, it's the salaries. So this is the salaries of like your administration staff, your CEO, your HR director, your chief financial officer, etc. Then the office rent, depreciation, advertising, telephone, internet, and you come up with your total operating fixed cost. So here you have your total operating expenses, so $109,800 for variable, $33,000 for your fixed will give you your total operating expenses. So now that we have all of that information, you can now calculate your budgeted manufacturing costs per unit. So we know we have our direct materials, our direct labor, and this is done on a cost per unit. Then the manufacturing overhead, it had a fixed component and a variable component. So we're putting both on a per unit basis. So we have your variable costs were already given to you on a per unit basis, but your fixed cost, you're basically going to take your $30,000 a month in fixed costs times 12 months, $360,000. You're just going to divide that out over your 400,000 cases. So it gets allocated out at 90 cents per unit. So now we can see the total manufacturing costs for each case of the tortillas is $12. But we're not done yet. So when you do that, you now are in a position to do your budgeted income statement. So you have your sales, your cost of goods sold that we just calculated. This will give you your operating profit. Then you have your operating expenses. And we know there's a fixed and variable components built in there. Will come down to your operating income, then income tax, and finally net income. So that is how you get to your budgeted income statement. But there's yet more budgeting to be done. Now we have to do the cash side. So you'll recall that some of their sales were for cash and the rest was on credit. What you are going to do here is you're going to break down your cash collections into what was collected in cash sales in each month. Then in each month, what you collected from the sales in previous months. So in January, you collected $120,000 for cash sales. Then in January, you were collecting $425,000 from December sales and $67,000 for November sales. So you'd always be given this information in a problem. For example, you would be told how much was going to be collected. So here it's 85% of your credit sales, collect that within 1 month, 14% in 2 months, and then you're going to have 1% bad debts that you're not going to collect. So it's pretty straightforward to calculate it. So here is your cash collections. So now that you know what the cash collections are, now you want to calculate the payments. So when you're buying your material, you have to calculate the cash payments for your materials that you're paying for each month, the labor cost, then the overhead. So you'll recall overhead is made up of a variety of accounts. So the total overhead is $102,000 for January. But included in overhead is depreciation. So it's an expense in terms of calculating the total cost of producing the product. But depreciation is not a cash expense. So because it's not a cash expense, we're going to remove that from our cash. Then the property tax, that's only paid twice a year. So for monitoring your cost point of view, you would allocate tax based over 12 months, but that's not really how it's paid. It's paid twice a year. Then you have your payments for your property taxes and insurance. So what you have here is total overhead cost. Then you want to take out of that anything that's not cash, and then add back in the actual cash payments. So that brings you down to 107. We're doing all of these cash payments for a reason, because we want to total everything up. So here you have your operating expenses, less depreciation, less bad debt, and that's your total cash operating. But we're still not done. We need to put everything together now in a full cash payment budget. So it's the cash payments for the materials that you've purchased, your payment for your direct labor, and the cash for the manufacturing overhead. So you see how complicated this is. It's not difficult. It's just a lot of calculations. So just to remind you, that 107, we calculated that back here, right? So in this one, we were billing our cash payments budget for our materials, labor, and overhead. So the overhead number is right here. So now you see you're bringing that forward. And the cash payment for operating expenses, again, that was the previous schedule we just did. Then if you're making any capital investments, say for instance, maybe you're buying a new piece of equipment, that's a cash outlay of $125,000. Then you might be declaring some dividends, paying some dividends to your shareholders. That's a cash outlay of $25,000. So now everything in, your materials, your labor, your overhead, the operating and the capital cost, total cash payments for the month of January is $653,000, and then you follow the same process obviously for the following months. We finally add it all together because what we want to find out is of the cash we receive less the cash we pay, is there a shortfall? Are we going to have to borrow money from the bank to cover the shortfall? Are we going to need a line of credit? That's the whole point of this, because if you need a line of credit, you've got to arrange that in advance. You can't just run into the bank at the last minute and say, oops, I need $20,000. These budgets have got to be done in advance, and typically they're discussed with the person at the bank who's in charge of your account. So you need to have all of this done well in advance of the beginning of the year. So the total cash budget started off with $36,000. We've just calculated, we know we need $612,200. That's what we're going to be collecting. That's all the cash from cash sales in the current month and previous months. Cash payments, $653,000. We have really what this is showing now, you have a shortfall. So your payments are greater than the cash that you've taken in. So you're going to need, you're going to have a negative balance of $4,900. And you're going to borrow $20,000. Typically, you wouldn't go and borrow, $4,900, $4,500. It would be like a round number. So, like in this case, they're going to be borrowing $20,000. So that's going to leave them with $15,000 and change at the beginning of the month, because at the end of January you've got your 15,000, and then you bring that forward to February, and you just follow the same pattern. So as you can see, it's a fairly lengthy process to calculate all these budgets, but you have to do this to figure out where the company is standing from a cash position. Now that you've got all of these initial calculations done, managers typically would do some sensitivity analysis. We call it what-if analysis. What if you don't sell as many units? What if there's a delay in collections? There's all kinds of what-if analysis you can do. Then you have to consider the impact that that would have on your budget, and then you'd have to revise your budget accordingly. So when we're looking at accounting, at responsibility accounting, a responsibility center is a subunit of an organization. So a department could be a cost center, it could be a revenue center, a profit center, or an investment center. It's just a way to evaluate the performance of the managers and the activities they supervise. So a cost center would typically be, the manufacturing plant. So those managers are responsible for managing the cost. If you're a revenue center, that's your sales department, so you're going to be evaluated on, the level of sales that you bring in, and so on. So you want to match how you're being evaluated with the type of center that you're responsible for running. A profit center, you would look at the line of products that you're responsible for generating income. And in an investment center, you're responsible for the invested capital. So when you're doing budgets, you're going to get a lot of variances, obviously, because you're predicting your budget. You're doing it in the fall of the year for the following year. So, they are just estimates. Hopefully you'll be fairly close, but you don't want to look at all small amounts if you're under or over. The idea here is to investigate only large budget variances that are material. Just focus on where the attention is needed. If something is off by a few dollars, you don't have to look at that. You're just looking at material or large amounts. And then you have to identify, why did we not make as much money? Well, if we didn't change our selling price, and if you didn't make as much money, obviously some expense must have increased. So maybe there was a huge increase in electricity prices. Maybe one of your suppliers had a big increase in what they were charging you for the materials that you purchased for them. So it's not like a question of blame, it's understanding why the costs have changed. Or why the revenues changed from what you had predicted. So you only want to look at things that are not where you had thought they would be. When you're doing analysis, there are a lot of tools at your disposal. Typically people will use Excel spreadsheets. You can use pivot tables, use graphs, regression analysis, and so on. So there's a lot of different budgeting tools at your disposal. The budget that we looked at, and we went through the detailed example, that was, for a merchandising or manufacturing company, whereas if you're a service company, the budgeting process is a lot easier. You have your sales, your operating expenses, then you do your income statement and your financial budget. So it's pretty straightforward. If you're a merchandising company, then you are buying materials that are goods that you're going to be reselling. So then you do have the additional accounts for cost of goods sold, your inventory, and so on. And so for the merchandising company, the example we looked at in detail for the budget, where we got into the materials and labor and so on, that's a manufacturing company. So for a merchandising company, say if you're Walmart, you're buying products that you're going to sell. So in that case, you're going to look at your cost of goods sold, which that's the inventory that you plan to sell during the month. Then you don't want to run out. You want a certain amount of inventory left at the end of the month. So that gives you the total amount you need to buy. But then you had some inventory on hand at the beginning. Subtract that tells you how much you need to purchase. So I know it's a lot of detailed information, and the only way to really get a handle on this is to actually do the problems in the chapter, and that will really help you understand. And also there's examples in my demonstration videos where I'm using Excel and showing you how the budget is done in detail. So the PowerPoints, they're a high-level overview. Details, you really need to practice it. Okay, and that concludes this chapter.